Good afternoon and welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me at MarketSite is Richard Johnson. He's with the Market Structure and Technology Group over at Greenwich Associates. We're going to take a look at a new survey that his team just published, blockchain adoption in the capital markets. Richard, thank you so much for joining us back again at MarketSite. Now tell us about that new survey that was recently published. What was behind the methodology?
Yeah, so we spoke to over 200 financial services executives actually working on blockchain. 93% of them were either decision makers or actually involved in it. And we asked them a variety of questions around what they're doing with the technology, what is their team size, what are their budgets, what type of projects are they working on, and things like that, just to kind of get a feel of the lay of the land where we are now. And it's actually a follow-up to a study we did back in 2016, so we were able to kind of look back and see how things have changed since there and how its opinions shifted.
Does the technology show promise, and what's the primary benefit behind blockchain technology in the financial markets?
Well, certainly, it certainly shows promise. That's what the feedback we've been getting. Over 60% of the firms we've spoken to have done proofs of concept, and they've got good results from that. In terms of the benefits, one thing we saw coming out of this study was that everyone's a lot of focus on improved operational costs. So with a blockchain, you have a kind of a central database of records and transactions, which is verified among participants in the market. That can reduce errors because you're looking at the same records. And also, when you add smart contracts on top of that, which is a form of automation, it allows you to automate a lot of processes. So reducing operational costs is a big factor. What's interesting was that shortening the settlement time, which was something that showed up quite highly as a strong driver in 2016, was not as important this time around. If you think about where blockchain came from, it came from Bitcoin. A lot of the attraction to it was that Bitcoin transactions could settle in 10 minutes to an hour, whereas US equities were 3 days or 2 days now. The focus has shifted away from shortening the settlement time. So I think that's kind of an interesting thing to come out of it. I think possibly the reason is that a lot of the kind of enterprise blockchain initiatives that people are working on are looking at it more from a post-trade point of view. And also, what happens in markets and settlement is that there's netting. So what that means is that all the trades are netted out, so buyers and sells between different counterparties are netted out, so that the actual amount that is settled is much lower than what was traded. Now, with blockchain, if you're doing the settlement at the same time as the trade, you wouldn't be able to get those netting benefits.
What are some of the other key drivers outside of operations?
One thing that came up was new revenue opportunities, which I think is great. Initially, a lot of people spoke about reducing costs and so forth, but there are revenue opportunities out there. If you can make a market more efficient, leveraging blockchain technology, then you can bring more participants in, and you can make it more competitive and increase the size of the market overall. I think that's going to be important moving forward, because if you're trying to sell this technology in corporate boardrooms, saying that you can create revenue is going to resonate more sweetly than talking about cutting costs.
Well, expectations are quite high for blockchain adoption. Where are we right now in the industry?
So I still think we're pretty early. I mean, in our study, 14% of the firms we spoke to had some kind of production implementation. These are not massive enterprises. I think it's more like things like proxy voting or recording transaction data onto the distributed ledger. That said, out of everyone else we spoke to, about 78%, I think it was, said they hope to have something in production within the next 2 years. But yeah, we still haven't seen the kind of a lot of the groundbreaking promise that was first hyped a few years ago. What
do you estimate annual budgets will be across capital markets, and is enterprise spending, is it higher or lower than the public blockchain?
Right. So on average, the budgets within, say, a typical investment bank, a larger investment bank that's investing in this, they're spending about $3 million a year now, which is up from $2 million. Average headcount of about 18 people. If you extrapolate that across the industry, we reckon that annual blockchain spending now stands at about $1.7 billion per year. So that's an increase of about 2/3, which is a big number, of course. But then you look at what's going on in the public blockchain space and all the ICO fundraising, which stands at about $7 billion in 2018 to date. So it's many, many times bigger than what's happening in the enterprise blockchain space. Now, yeah, absolutely. A lot of these ICO things are scams and not real projects, and they're not going to go anywhere. But the money is coming into space, and people are working on these initiatives. I think there could be, to the extent that people are working on decentralized applications around the Ethereum blockchain, there could be some crossover and cross-pollination with the enterprise Ethereum initiatives.
Well, to rebuild the financial markets on blockchain, the technology has to meet the needs of all market participants, right? So production is one thing, transforming an entire industry like the capital markets is something else. Are we in the first inning, second inning?
You know, I think we're first inning, or first or second inning, certainly nowhere near the end of it. The feedback we get from the people working on the technology is that they're very optimistic. I think, you know, generally about 80% said that we'll see meaningful change, transformational change within 2 years. Within one use case. The thing is, that's what they said 2 years ago as well, and we're not there yet. And then, so you think about maybe it's 2 years, maybe it's 5 years in one use case, then try and extrapolate that across the whole industry. You know, you're looking at possibly 10 years or more, you know, if it does take off.
What are one of the more promising use cases?
Payments is the most promising, the one that most people work on. It's a massive market. You know, money is needed for everything. That's how capitalism works and the world works. And also, you know, I'm talking about, you know, remittances, consumer payments, all these types of things. But also, if you're doing a trade of an asset, whether it's an equity, a bond, or whatever, there's always a cash leg as well. So it's maybe one thing having the asset digitized on the blockchain, doing the trade that way. You've still got to do the other side of the transaction, which is the money. So payments is number one. Right up there, though, was trade finance, which is, you know, very different, really. It's about, you know, companies figuring out how to finance you know, their trade demands,
right,
eventually. So if a firm wants to buy, you know, 1 million widgets from China, how do they pay for that? The Chinese company may get the bill of sale. They may refactor it, meaning get payment up in front, so they can build these widgets for the company. And then you've got to track the shipment and so forth. So there's a lot of moving parts in trade finance and a lot of money moving around and documentation to track. So a lot of firms are looking into trade finance.
All right, and to wrap up, what are some of the challenges and hurdles that the industry has to overcome for mass adoption?
So I think, you know, the rubber's hitting the road now. We're moving from POC to production. I think people are finding that it's harder to work with than they thought it was going in. A majority of executives told us that. Some of the key challenges are, you know, first of all, the interoperability. So, you know, you've got to build backwards compatibility to how the markets work today. You can't just start from scratch. That makes it very challenging. And the other thing is you know, hiring skilled technologists. Then, you know, they're just, you know, it's such a new technology. There's a limited source of people to recruit from.
All right. Well, thank you very much for joining us at MarketSite as always. And thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.